Imagine this for a moment. You're earning money while you sleep. Every month, consistent cash flow lands in your account, all from investments designed to pay you for simply holding them. That's the dream of dividend investing, the allure of passive income that keeps millions of investors coming back, year after year. But here's the reality. Not all dividend ETFs are built the same. Some deliver sustainable, long-term income with slow, steady growth. Others promise high yields but mask silent erosion, losing value in ways most people don't notice until it's too late. So today, we're breaking down 3 of the most talked about dividend ETFs heading into 2026, the YieldMax Ultra Option Income Strategy ETF, better known as Ulti, the classic Charles Schwab U.S. Dividend Equity ETF, or SCHD, and the rising star of high-income investing, QQQI by NEOS, a NASDAQ 100-focused ETF. Now before we dive in, this isn't financial advice, it's an educational look at how analysts, investors, and market dynamics are shaping these funds' futures. Dividend investing has become a cornerstone of personal finance strategies around the world. Investors love the idea of their money working for them, generating regular income without the need for constant trading or speculation. And 2025 has already proven to be a fascinating year for dividend ETFs. Some have delivered steady returns, others have struggled under the weight of their own payout structures. Take SCHD, for example, a fund that's been relatively flat in performance this year. On the other hand, Ulti has shown strong total return potential, though not necessarily from price appreciation, rather from its impressive income distributions. Meanwhile, QQQI has been the standout performer, delivering both share price growth and consistent total returns. But the big question investors are asking now is, how will these funds perform heading into 2026? ULTY, short for the YieldMax Ultra Option Income Strategy ETF, is built for one purpose: generating high monthly income through an advanced options strategy. It's what's known as a covered call ETF. Essentially, it generates returns not only from the assets it holds, but also from the premiums collected by selling call options. This strategy can deliver eye-catching yields, sometimes in the double digits, which naturally draws in investors chasing passive income. But as many professionals caution, high yield doesn't come without cost. Covered call ETFs by nature limit their upside potential. When markets rise sharply, the call options cap gains. When markets fall, the ETF still absorbs losses on its holdings. And because Ulti distributes such a large portion of its income, it can struggle to maintain its share price over time, a phenomenon often referred to as NAV erosion. So, while the cash flow is strong, the long-term price stability is not always guaranteed. According to data compiled from analyst forecasts on TipRanks, Ulti currently carries a moderate buy consensus rating. Out of the total analysts covering it, 14 rated a buy, 11 suggest holding, and none recommend selling. That's a balanced outlook, not overly optimistic, but confident enough to signal potential opportunity. Looking ahead to 2026, analysts have set an average price target of $5.59, representing roughly 12% upside from its current level. The highest projection comes in around $8.30, while the lowest target is about $3.64. Now, let's interpret that realistically. Given Ulti's structure as a high-distribution ETF, it's unlikely to sustain rapid price growth. The generous income payouts naturally weigh on share value. Dividends don't come out of thin air. Every time an ETF pays a dividend, the share price adjusts downward by the same amount. So, while some might hope for that $8 price target, the more conservative estimate near $3.60 might actually be the more accurate reflection of where Ulti could land by the end of 2026. That would represent a potential downside of about 27% in share price. Though, and this is key, that's only based on price. When you factor in the dividends, the total return could still be positive. This balance between yield and price stability is the defining feature of Ulti and similar ETFs. They're not built for explosive growth, they're designed for cash flow. Interestingly, Ulti has developed a strong following among younger investors. Data shows that those under 35 hold over half of all Ulti positions on tip ranks, making them the largest group of investors in this ETF. But the market shift since the early 2020s, especially with the rise of passive income investing on social media, has changed behavior. Many young investors now see dividend ETFs as a pathway to financial independence, even if it means slower portfolio growth. Meanwhile, investors aged 35 to 55 represent about 24% of holders, and those over 55 account for just under 24%. It's a surprising distribution, one that reflects how the investing culture has evolved. On average, only 0.5% of portfolios on tip ranks hold ULTY, but those who do allocate a significant portion, around 8% of their portfolios. That's a bold commitment to an income-focused product. So why do so many investors, especially younger ones, flock to a high-yield ETF like Ulti? The answer lies in certainty. In an unpredictable market, the promise of consistent cash flow feels safer than chasing volatile growth stocks. Even if the share price fluctuates, the steady income acts like a financial cushion. It's a strategy rooted not just in returns, but in peace of mind. However, the cautionary message remains. Dividends aren't free money, they're a distribution of the ETF's own value. Over time, those payouts can gradually reduce the fund's base price unless offset by capital appreciation or reinvestment. That's why experienced investors often reinvest dividends rather than simply collecting them, allowing compounding to counteract NAV erosion. Ulti represents the modern investor's dilemma perfectly, choosing between high immediate returns and long-term growth stability.